Hello and welcome to New Economic Thinking. I'm here today to discuss this book, Money, Finance and the Real Economy. It's written by Professor Anton Brender and Associate Professor Florence Pisani, both of Dauphine University. Thank you both for joining me today.
Thank you.
So the proper title is Money, Finance and the Real Economy, What Went Wrong? So what did go wrong?
Many things. So it will give us some material for discussion. But basically, what we try to look at is the way the financial system functions and the fact that you overlook part of this functioning, the day-to-day functioning of the financial system, has led to many of the problems we're confronted with today. And this is the point we try to make. So what went wrong is just the fact that we've been leaving finance on its own. And finance on its own is something that on a very regular basis has been leading to disasters, while at the same time trying to control finance, not only to make it more cautious, but to try to structure it in a proper way, could be a very useful tool to promote growth in the world economy, and precisely we believe that today this is what we would need.
So as you say in your prologue, it's a very timely book because we are in the midst of recovering from a recent financial crisis, and yet it's timeless in the sense that we seem to have these crises every few years. This classic intermediation between credit and the real economy. This seems to create bubbles, financial crises, the aftermath that we clean up. We don't actually ever seem to learn, unfortunately. Each time we seem to make the same mistakes or very similar mistakes. Do you think this book will help us avoid these mistakes in the future?
Well, we can hope so, but if we are optimistic. No, the idea is that if we do not look at the solidity of this financial system, if we don't take care of this financial system, if we don't try to build some new financing channels in this system, it will always lead to a new disaster. We have let the system functioning on its own. We didn't make any effort to build an international, truly global financial system. We live in a globalized world, but if you look...
We live in a globalized world, and yet we have national regulation. Is that a problem?
We have national regulation, but we also have national financing systems. If you look at the financial system in the US, it does not function exactly the same way as the financial system in Europe. And inside Europe, you have 18 financial systems. So financial systems are mainly nationals. The way those financial systems work, their propensity to lend to non-financial agents are not the same. So we didn't make any effort in order to have a properly working global, truly global financial system.
And as you say, you've mentioned Europe. We've discussed this before. Reforming the European banking system is a particularly formidable task because, as you pointed out, there's 17 different nations within the Eurozone, and you have very distinct banking systems. For example, Germany's form of credit intermediation is very different from Spain's. Do you want to elaborate on that a little bit?
Sure, because reform in many fields, by the way, could mean many different things. Now, the kind of reform we've been doing right now in Europe is trying to make all the regulatory aspects of the functioning of the banking system rather identical. But this doesn't take care of what is very different and still remains very different. It is the lending practices. They are very different across Europe. As Florence said, they're also very different in the US from they are in Europe, and so on. So the fact that the lending practices are very different makes a huge difference, because the beginning of all the intermediation process is first lending, and then the way when the loans are made, the risks, assessing the risks by the lender, but then also allowing those risks to be redistributed and to circulate within the economy. All those things are part of what we call financing channels. That is, it begins at the window of the bank that makes the loans, but it ends up, at the saver who holds the savings that are the counterpart of the loans that have been made. Those financing channels today are very different in the US, in Europe, across European countries. They are non-existent in some parts of the world. And this is what we call the structure of the global financial system.
And if you look at the response of each system to monetary policy impulses, just look at within Europe, they are very different. When the ECB decreases its rate, households in Spain will normally react instantaneously because they borrow mainly at interest rates indexed on short-term rates. While German households will not respond as forcefully because they borrow at long-term fixed interest rates. So the way monetary policy is transmitted will be very different because all those financial systems has not been harmonized. We have one monetary policy, but 18 financial systems.
So the fundamental conceit behind the common currency was that the longer that you yoked all countries under a common currency, the more the economic divergences would be minimized. But in fact, it's very hard just to change, make top-down changes when you haven't got these bottom-up changes in the banking structures.
Yes, it is. At the same time, one point that we try to insist on, and that is often overlooked, is the normal way for monetary policy to work is mainly by influencing household borrowing. Contrary to what many people believe, when you move interest rates, it's mainly household borrowing that responds. Why is this important and relevant? Because it is precisely for household lending. Think of mortgage lending. Those things are done in very different ways across Europe, in the US, and in many other parts of the world.
So, for example, the 30-year mortgage is virtually non-existent in Europe.
It's almost non-existent. As Florence said, in Spain, you borrow for a long period of time, but at variable rates. In Germany, you borrow for, let's say, for 10 years at rates that will be fixed, so that if long-term rates fall, mortgage rates fall, you won't benefit from it if you already borrowed. And in the US, you know the system, you can prepay any time. And of course, when interest rates fall, you'll benefit from the fact that you can renegotiate your loan. So that the transmission of the changes in interest rates will be very different, especially when there are some contractionary forces in the economy and interest rates fall, because in the US, it will provide a huge stimulus to household spending. In Germany, it won't provide any stimulus.
And yet, when we talk about banking reform, particularly in Europe, there is talk about progress being made because of the fact that the ECB, the European Central Bank, is taking a much more prominent regulatory role. But it doesn't address the issues that you've raised here.
Exactly. It doesn't address this issue, especially so since the lending practices affect mainly borrowing by households, because you borrow from the bank that is at the corner of your street. You don't borrow on an integrated European market. It also affects SMEs, because those two do borrow from their local bank. It doesn't affect, what is really integrated in Europe, and even in the global economy, in the world economy, it is borrowing by big banks and by governments. But otherwise, people depend and rely on lending by their local bank branch.
And of course, the access to credit to small businesses is virtually non-existent in most of these countries.
And this, in some countries, those financing channels are just clogged, which means that they do not work as one would expect them to.
So maybe the answer is that we are focusing too much on having a credit-based society, and really what we ought to be focusing on is having more of an income-based society, which really takes us back to fiscal policy, generating higher employment, rising income, so that people become less dependent on credit channels. Do you consider that at all in the book?
Unfortunately, as you know, in Europe and even in the US in some respects, the idea is that government should now borrow more and spend more is something that is debated, to say the least,
yes.
At least in Europe. It is even more debated than in the US, so let's assume it's constrained. The story is that governments, of course, could borrow as a savings that are available today and invest them, but if they don't do it, we still could think of supranational organizations that would borrow and tap the available pool of savings. There is a huge potential of saving in the world economy.
In Europe, the European Investment Bank is often used.
Yes, but at the global level, you have the World Bank, you have various development banks. China has just been proposing, the building of a new Asian infrastructure investment bank. And this is very much one of the things that should be done.
This is a very important new development. It's only happened in the last few weeks. Of course, the Americans opposed it, but many European countries supported it. But you seem to think it's a very positive development.
Yeah, it's a very positive development because it allows some excess saving, potentially excess savings, to be channeled to investment needs. And you have plenty around the world investment needs. No, what is happening right now is that it's very paradoxical, because at one hand, you have a lot of savings potentially available. On the other hand, you have a lot of investment opportunities, but there is no channels to allow the investment to be financed by the savings.
It's the banking equivalent of Rousseau's paradox. You have man is born free, but everywhere in chains, actually.
Exactly, and this is why, as you mentioned at the very beginning, there is a timely part to our story, there is a timeless part to our story. And the timeless part is just the way a monetary economy is working. We live in a world in which paper money, provided by credit, is the money we use, but it's not the deposits that make the loans, it is the loans that make the deposits.
Yes.
So if we don't make the loans, the deposit just won't show up. And this is precisely what is putting a huge contractionary pressure right now on the global economy. China could save much more if there would be an outlet for those savings. That is, if loans would be made, you'd have more deposits showing up in China. But loans are not made, at least not sufficiently, and China has to adjust so that deposits won't show up in China. There is only one way to do it. Less growth in China will provide the forces that are needed for the deposits that cannot show up, not to show up, so that people won't desire to save as much as they would.
Well, I think you made a very important statement before, because I think the classic depiction that we have in the economics textbooks, you have a fractional reserve banking, and that the banks take a portion of those deposits, they lend it on, and of course it's exactly the opposite. You've got the causation, right? Loans create deposits, and so the implication of that is that to make a loan, you've got to have a credit-worthy borrower on the other side. And of course, if you have a constrained fiscal policy, then of course your customer is not very credit-worthy, and it's much harder for the bank to extend a loan.
It's even impossible. And if you don't have any financing channels, that are available, loans will just not be made. That's why the move by China, we believe, is very relevant and very significant of the kind of forces that are pushing the world economy, on a contractionary path. They try to build a new financing channel. The World Bank, could lend much more. The European Investment Bank could lend much more. They just don't.
It's an interesting proposal. If you go back in time, I remember I was around at the time of the Asian financial crisis, and before that started in 1997, the Japanese proposed an Asian monetary fund, which again, by a parallel history, that was shot down by the Americans. So that this time, and arguably, that if we'd had an Asian monetary fund, maybe the Asian crisis would not have been as severe.
Yeah, exactly, because the financing channels, that you have financing channels that have been at work, but they are very fragile. Especially if you look at the Asian financing crisis, or also at the European financial crisis right now, what happened is the following. A lot of money has been flowing, let's say, to Asia at the end of the 90s, but it flowed through very fragile channels. You had European banks lending money short-term to Asian banks that borrow it and lent it long-term. So the lending was done, but at any time, the money that funded it could be withdrawn, and it happened.
And the financing structures themselves, I recall, were very, very unstable as well.
They were, by nature, because financing long-term loans, made in local currency by borrowing short-term in foreign currency, is a sure recipe for disaster if there is nothing to stabilize the system.
And before you talked about financing risks, one of the things that's really changed over the last 20, 30 years has been the growth of securitization. And that in itself creates a different kind of funding risk. In fact, it changes the whole mentality of lending, because instead of a bank saying, well, I've got to do my credit assessment because this is going to be on my books for the next 7 to 10, 15 years, you have a situation where the investment banker largely, he slices and dices this loan, and his main concern is, how am I going to get paid and how am I going to sell these loans off? So the notion of credit risks, I think, changes markedly. Is there any way of, should we first of all be reversing that process, or is there any way of incorporating a new kind of credit risk assessment given the changing dynamics of credit intermediation?
I think we should take care on the way the risks are born. So the process in itself is not a bad one, because it allows the system to carry the risk. You have a kind of international financial division of risks. Each agents, financial agents across the world can take only part of the risk. Some took the US credit risk of households, some took interest rate risk of those lendings, some others took the foreign exchange rate risk because you had savings in one part of the world, borrowing in another part of the world. So for all those international transfers of savings, you had a lot of risk to be borne. So if you can split the risk, in itself, the process is not bad in itself.
In theory, that's right.
Theory.
But of course, in practice, it didn't work that way in 2007, 2008.
But that's a problem, because if you let finance on its own, it will always happen. If you don't look at the system and at how the risks are borne, it will always lead to disaster.
Because one of the things that people don't insist on is that securitization itself, is not bad. And it has been working in the US, for instance, for decades, in Denmark, for not centuries, but almost, and without problems amounting. But the reason is simple. If you securitize loans that are made according to specific norms, and if you monitor the fact and check the fact that all those norms are respected, which is a big condition, then you can very well, have the loan sold to people who will, in a way or another, be able to assess the risks thereby. But if the loans are made, they respond to no norm, like you don't check if the guy who you're lending money to has an income, which was the case with the subprime loan in the US, then nobody will be able to assess the risk he's buying. So the fact that you can assess the risk you buy in a statistical way, you don't have to know the person,
Well, of course, you don't need to know the person, but of course, you hope that, for example, that there is a rule of law, and that, as Bill Black has pointed out, and George Akerlof, there was widespread fraud in the dissemination of these loans, and I think that's something that's a regulatory failure.
That's a problem. But fraud is not necessarily associated with securitization. You have fraud in many fields, and securitization by itself, is not more fraud-prone than any other if you try to avoid it, which we didn't do.
So I take it from that that you are not in favor. There's been some discussion that, in a sense, throwing out the baby with the bathwater. Many people saying securitization is a bad thing. Let's go back to basic banking activities. Banking is public utility. That superficially sounds very attractive, but I think you would argue that it's impossible to close Pandora's box, and that you wouldn't really want to in any case.
We wouldn't even call it Pandora box, because the problem is that if you want to have only banks making the loans, you need to put a lot of equity in the banks, especially if you want them to respect the kind of rules and regulation we give them now, so that the lending capacity of our financing channels will just be restrained. So the fact that you can have people who are not just banks that carry the risks of the loans that are made, you have plenty of pension funds, who will not be able to lend the money they collect if you don't securitize some of the loans that are made. So securitization is a way to allow people who collect savings, but who are not banks, to invest in the loans that are made, to finance those loans. And that's why, exactly as you said, we're not in favor of closing this securitization box and forbidding it.
Which does also raise another question. There is talk, now that you have essentially a dealer-based system, which is the outgrowth of securitization, it's hard to envisage a situation today where the central banks effectively withdraw from that situation. And there is some talk of normalizing the role of the central banks, reducing their balance sheets, etc. But maybe the alternative is that they should never exit the current function. They have to remain as, if you like, a dealer of last resort to ensure that the system remains solvent. And to have the solvency, you ultimately need the currency issuers there as the ultimate backstop.
Absolutely. What we believe is, unfortunately, the kind of financing system we are going to have, finance being what it is, even if we try to structure it in a more proper way, is a system that will have a relatively narrow stability band. And it's very easy to push the system out of this stability band because it reacts very quickly to risk. Risk aversion increases very quickly and so on. And all of a sudden you have everybody wants to sell. And when this happens, the system can be very badly destabilized, as we've seen that during the Lehman Brothers crisis. And the only way to stabilize it is for central bank to come in and buy what people are selling. And by doing this rather preemptively, at some moment, they can avoid the system to be destabilized. They have to be present all the time to keep it in its stability band, which is an exercise that is not so easy.
So instead of having AIG, for example, exercise the insurance, it should be someone like the Federal Reserve or the European Central Bank, for example, but maybe charging the proper kinds of insurance rates so as to ensure the activity doesn't become too dangerous.
Yeah, and then it also modifies the role of central banks, because up to now they were supposed to be just lender of last resort, and we think that they also need to be buyer of last resort.
Or counterparty of last resort.
Counterparty of last resort.
Risk takers of last resort.
Or market makers of last resort.
Which is the other way of looking at
yeah.
it.
Yeah.
And actually, derivative markets could be a very efficient tool, for central banks to intervene, because what happens in the derivative market is just that you exchange risks. One is selling it and the other one is taking it. And if the private sector all of a sudden wants to get rid of the excess of risk it has on its hand, the central bank can provide a counterpart just by acting on the derivative market. Unfortunately, central banks, for various reasons, are very reluctant to intervene also in the derivative market.
Instead of placing Fannie Mae and Freddie Mac under conservatorship, what the Fed could have done at that time is just sell insurance on Fannie Mae and Freddie Mac.
Yeah, absolutely.
So that's another way of intervening, but they were, of course, very reluctant to intervene.
They were reluctant,
on the
and it is a brave new world, but as you suggested, that might be the way out going forward so that we don't have any more situations. So in the future, we can say money, finance, and the real economy, what went right? And on that
but
note,
there is a long way.
It's a long way. We still have a long way to go, but maybe if this book is read first, that will help to ensure that our global regulators take the right track going forward. Anton Brender, Florence Pisani, thank you very much for joining me today. It's been most interesting.
Thank you very much.